Good day, everyone. David Paul speaking. It's the last day of 2019, and I want to quickly do a review of the VectorVest worry-free investing methodology and how it did in 2019. Very simply put, the VectorVest worry-free investing technique buys the UK's safest shares when the London stock market is rising. And let's start with the London stock market over the last 15 months odd. The chart that we're looking at is the VectorVest Composite, which is a equally weighted index of all of the shares that we follow in London, 2,200 odd shares. I think you can see the green and the red triangles. Those represent the longest term measure of the trend on VectorVest, and you can see that last October 2018, not last October, October 2018, the longer term trend turned down. We had quite a savage pullback into January about this time last year. We got our first buy signal from the confirmed call methodology on January the 9th, and although there was a little bit of whiplash during the course of the year, none of these signals were too severe during the course of the year. So as we go into the last day of the year, the trends are looking still quite strong. A little bit of a pullback yesterday. Wouldn't be at all surprised to see this come back over the next day or two and kiss these tops. That would be quite normal, in fact. So the summary on the front page of VectorVest, I've just taken a snip of it, is that the short-term trend, this first word is up, the underlying trend is up, and this confirmed up is that confirmed signal, that green triangle that I spoke about. It's the underlying trend confirmed by price action. And the traffic light shows us that although the underlying, short-term trend is up, it's lost a little bit of its strength over the last day, and VectorVest advocates caution when buying stocks at this time. So the short-term trend has turned around a little bit. So that advice is very good, is really good advice. So just be cautious and maybe wait for it to turn back up again. So we want to buy the UK's safest shares when the overall market is rising. And on VectorVest we have a metric that measures the safety and the predictability of the earnings. It's called relative safety. And this is comprised of these things: earnings consistency, the size of the company, a little bit about volatility, how long the company's been around for. Dividends are very important. A company that pays a dividend has got a history of paying that dividend reliably and growing that dividend marks well on relative safety. And then, of course, there are the many measures of the accounts over the last few years, of which the one that I look at most is the debt to equity ratio. So a measure on a scale between 0 and 2 of safety and predictability of the earnings. Above 1 is fair, above 1.3 this is a company that's making money, and all of those financial ratios are getting better. And in a worry-free investing technique, a hands-off investing technique, we want to focus on these shares. So here's the process, folks. When we get a confirmed up, which is one of those green triangles on the VectorVest UK composite chart, we buy high relative safety stocks. 10 of them in theory. Do our best not to have any more than 2 from one sector of the economy. Now, if the general market is rising, there is a very slim chance that one of your shares will pull back and you'll get stopped out. High RS shares tend to be quite resilient. It could happen. If it does happen, then have a look again, run the RS UD search that I'll talk about in a moment, and replace, so that when the market is rising you're always fully invested. Now, sooner or later there's going to be a confirmed down signal. When you get a confirmed down signal, do nothing. But in this case, if you are stopped out, and you're more likely to be stopped out if the market is falling, then don't replace, build a cash position. So if, for example, the market falls and we get a serious pullback like the one we had October, November, December last year, you could quite easily get stopped out of 3 of the 10 shares. That would mean that you'd be 70% in shares and 30% in cash. When the next confirmed up comes, then run the search again and make sure that you're fully invested with no more than 2 shares out of the one sector. That's the search. It's called Long-Term Winners RS Descending. It's a pre-populated search on VectorVest. It looks for shares that are over 50 pence, that have a reasonable volume, not on AIM. That little double arrow means not on AIM, where the stock's price is less than the VectorVest valuation, and the stock's not on a sell recommendation. It's on a buy or a hold recommendation. Very importantly, these are sorted by relative safety. That brings those shares with the best track record of making money safely to the top of the pile. And when I ran that using the VectorVest backtester, folks, that's what's happened over the last year. We started off with £50,000 at the first confirmed up on the 9th of January and ran it right through to yesterday's close. And that was the close on Monday the 30th of January, and as you can see, the £50,000 is now £72,000, which is 45% gain, excluding dividends, and many of those shares have paid a dividend along the way. Now there was only a little bit of trading in this pullback. We get stopped out a few of the shares here, and when there was the next confirmed up, we had to replace. So there was a little bit of trading in here. So it was an outstanding year for worry-free investing in the UK. That 45% I doubt will be repeated. When I tested this in the UK and in the US over 25 years in the US, it produces a 17% annual compounded rate of return. So an exceptionally good year for worry-free investing with very, very little to do. I think it makes an excellent methodology that's totally mechanical for your ISA money, for example. If I was managing money for anybody, I would put 60 or 70% into the worry-free methodology, and with the rest do some swing trading. So for those of you that are new to investing, an exceptionally good place to start. I hope this helps. Thank you.